Section 2, Chapter 21, Income Statements. In this unit, we will discuss 3 items. The learning outcomes would be how to prepare an income statement, how to prepare a vertical analysis of an income statement, and how to prepare a horizontal analysis of an income statement. So what is an income statement? An income statement is another important financial statement recorded and used by businesses. The income statement shows the net income of a business over a period of time. Okay? Balance sheets, of course, will give you a snapshot of the value of your assets, your liability, and your owner's equity at a specific point in time. Okay. There are several terms that are associated with your income statement that we must understand. How do we formulate an income statement? Well, we must deal with these particular items. First thing on your income statement, we will look at total sales. Your total sales would be earnings that the company receives from the sale of goods or the performance of services, depending on the nature of the business. If it's a service-oriented business, your gross sales would be the money you receive from rendering those services. Okay. Sales returns or allowances. During the course of business, there are times that products are returned, either they're not exactly what the customer wanted, or they could be some defects, some type of unsatisfactory situation, or a refund or an adjustment to services rendered. Net sales then would be the difference between your total sales and your sales returns or allowances. Then moving on, we would then determine what are our costs of goods sold. In the course of doing business, we must purchase inventory, products, material to be used in the production of our final goods. So how much would it cost the company to purchase those things? So the cost of the business for merchandise or goods sold is our cost of goods sold. We will move on to then determine how much or what is the gross profit or the gross margin. The gross profit or the gross margin would be the cost of goods sold subtracted from your net sales. So it is the difference between net sales and the cost of goods sold. Operating expenses then would be your overhead, the cost for running your business. This area we would include things like insurance, utilities, rent, employee salaries and benefits, all the different costs that a company would incur during the course of running the business. And finally, we will get to the point of determining what is the net income or the net profit of the business during that period of time. That is the difference between your gross profit or your gross margin and the operating expenses. So these are our terms, and these are your main sections that you will find on an income statement. So let's go ahead and prepare an income statement. Calculating the cost of goods sold is an important part of preparing your income statement. So we got to understand how to do that. And simply, you just must keep track of the costs involved, purchases of different items that are used in the production of your goods or services. Now, in this section on preparing an income statement, there's several steps. First thing we have to do is determine what are our net sales. And that is going to be found by taking the total gross sales and our total sales returns and allowances and taking the difference of those. That would give us our net sales. The second step would be to find and record the cost of goods sold, as we talked about earlier. What will be your cost of the beginning inventory? Record the cost of your purchases. Record the cost of your ending inventory. And then the last part of this section would be to add the cost of the beginning inventory and the cost of purchases and subtract the cost of the ending inventory. Okay, so your cost of goods sold then would be the cost of your beginning inventory plus the cost of purchases minus the cost of ending inventory. The next step on preparing this income statement would be to find and record our gross profit from sales. Our gross profit from sales would be our net sales minus the cost of goods sold. Okay? That would be our gross profit from sales. Then we move on and find and record the total operating expenses. You got to keep track of all of these things. Remember, this is accounting, and we must account for all sources of income as well as all uses of income, which are expenses. We must keep track of all of that. So in this step, we will total all of our operating expenses, list them, and add them all together to find this amount. And then last part of this, we'll find and record our net income, which would be the difference between the gross profit from sales minus your operating expenses. So this is the process in preparing an income statement. Let's look at an example. In this example, we are given some information. We're asked to complete the portion of the income statement shown for this current grocery store. Here's the information given. They told us what the gross sales are, return and allowances. They showed us what the beginning inventory is, cost of purchases, cost of the ending inventory, and the total operating expenses. This information now, we can go ahead and create the various parts of our income statement. Net sales. Net sales, we said, would be the difference between your gross sales and your returns and allowances. That makes sense, yes? If you totally sold a certain amount of products, but some of that was returned, well, we're interested in how much was not returned. That would be the real number, the net sales. Cost of goods sold, that's given to us, but that is determined by taking now our cost of the beginning inventory, add to that all of our purchases, and subtract from that the cost of the ending inventory. That gives us the cost of goods sold. Then to determine our gross profit, you got to subtract that cost of goods sold amount from your net sales. From there, we can determine our net income, and that would be the difference between the gross profit and the operating expenses. Taking all that information given, we can create our financial income statement, and this is a view of that income statement. So notice, the beginning of this income statement, we see the name of the business, the heading of this income statement, the type of financial statement this is, in this case, is an income statement, and then finally, the period of time that this income statement covers, the month ending June 30th. So, revenue. Revenue, of course, is all income that we receive. So under the revenue section, we record our gross sales. Then we say less any sales, and then we list our sales returns and allowances. The structure of this income statement is the structure that you want to use when you create and print out your income statement. Remember, generally accepted accounting principles tells us how we should organize this income statement so that from one company to the other, if you look at an income statement, they should look very similar because they are following a standard. So this is the order in which this should be created, and the layout is very much the layout you should use. Okay, net sales is given. Notice the difference. When they give the sales returns and allowance, there is a single line under there, and then the net sales figure shows up. And notice how they're using multiple columns here. You would also want to use the columns just as they're shown here. Then we go to the cost of goods sold section. In that section, we list the cost of the beginning inventory. Then we say add purchases. Single underline, then give your total there. And then you say less ending inventory. Add that. There's a single line. And then cost of goods sold goes all the way over in the far right column. And that would be the difference between this value here, 24,307, and your ending inventory. So your cost of goods sold is there with a single underline under it. Then we list gross profit or loss. It's important to understand you can lose money in the course of a business. So in this case, if your cost of goods sold is more than your net sales, then you have just experienced a loss. So in this case, your gross profit then would be the difference between net sales and the cost of goods sold. After you find that value, we must go down and then list what our expenses are. The operating expenses, in this case, we just give a general figure, operating expenses, one big figure, because that's what was given to us. We can break these down. Companies sometimes would like to itemize their different operating expenses to be able to understand where are their expenses, and to be able to, when we get into our analysis of the income statement, you might want to know from one period to the next, how are we performing and what are our different expenses and how does that look? But anyway, in this case, we list those operating expenses as one list item and then single underline, because that means that's the end of our operating expenses. And then the total expenses goes over in the far right column. The last section would be to take the difference between your gross profit and your total expenses. And that would give us our net income or loss with a double underline. The double underline shows end of the process, the final figure. Once again, if this was a loss, then this figure would be displayed in parentheses. That is the standard way we would use to show negative numbers. You can use it by putting a negative in front of it, but the standard, the general standard, is put it in parentheses. Okay, that is how we form our income statement. So at this point, it is probably a good idea for you to take a look at these stop and check problems. Go ahead, work it out. You need practice in how to work and form and prepare this income statement. So go ahead, try it out. And once again, check your answers with what's given in the back of the book before moving on. This is the end of this video. And when we come back, we will begin to discuss how to prepare a vertical analysis of an income statement.